Welcome to the Deep Dive. Today, we're tackling a really important and, frankly, evolving issue. How tariffs, both the ones we have now and potential future ones, could reshape technology investments.
Yeah, it's a big one.
You, our listener, flagged a fascinatingly detailed report for us. And our mission today is really to pull out the most critical insights. How these trade shifts might ripple across the tech landscape.
Absolutely. And the analysis we're digging into, it's from Morningstar Equity Research,
Yeah.
dated April 21st, 2025. And it takes a deep look at the likely consequences
Mm,
of tariffs, especially those involving China, on key tech sectors, hardware, semiconductors, even software.
right.
And it also gives a valuable perspective on the AI investment scene, and importantly, highlights areas in tech that might offer a bit more stability in these, well, uncertain times.
And for you, the listener, why should you spend your time with us on this?
Well, I mean, in today's world, everything's so connected globally, right? Political decisions can have these huge economic consequences, so understanding these dynamics is just more important than ever.
Definitely.
Whether you're involved in investment, maybe working in the tech industry, or you just want to understand the big forces shaping things, this deep dive is for you. We're going to try and cut through the complexity, focus on those key takeaways, maybe find those aha moments that clarify what's really going on.
Sounds like a plan.
Okay, let's unpack this. The report kicks off by outlining this changing geopolitical picture. What are the main shifts we should be aware of?
Well, what's really striking is the report's emphasis on this growing conviction, I guess you'd call it, that we're really on the cusp of a significant restructuring of technology supply chains
Restructuring how?
with a clear direction away from China. And this isn't just a hunch.
Yeah.
The Morningstar analysts point to several key U.S. policy objectives driving this potential shift.
Okay, like what? What are the key drivers?
Well, the main one is the increasing view of China as a major geopolitical competitor. That's pretty clear. Then you add to that a general wariness towards these highly globalized supply chains that rely so heavily on China. And the logical outcome, a desire to find alternatives.
Which leads to things like nearshoring.
Exactly. Nearshoring, bringing production closer, maybe same continent, and friendshoring, which is, setting up supply chains with countries seen as political and economic allies.
So if this shift really picks up steam, what are the practical consequences the report sees coming?
Well, connecting the dots, the report suggests we're likely to see more deals, more partnerships forming with countries the U.S. favors as these new supply chain hubs.
Makes sense.
And conversely, the chance of big new trade deals with China seems to be, well, fading. The focus will likely be on actively changing those existing supply chains running through China.
And some sectors are more critical than others?
Oh, absolutely. And the report highlights that sectors deemed critical for national security, and that definitely includes technology, will be right at the front of the line for these changes.
It's a strong reminder. I mean, the report mentions a recent pause on some tariffs, but it stresses that the tariffs on China are still very much in place.
They are. And new ones targeting semiconductors are expected.
Right. So it really underscores that the instability, the volatility in global supply chains, that's probably not going away soon.
Doesn't look like it.
Okay, so let's dive into specific sectors then. Starting with hardware, what are the major risks the report identifies there?
Hardware, according to this analysis, faces pretty considerable risks, mainly because of a significant reliance on imports from China.
How significant?
To give you a number, it's around 60% of PCs and smartphones imported into the U.S. They come from China. Now, what makes that particularly concerning is that demand for these products tends to be more elastic.
Elastic demand. Okay, let's just clarify what that means in real terms for everyone listening.
Basically, yeah, it just means if the price goes up, the quantity people want to buy is likely to drop, maybe quite a bit. Think about it.
Yeah.
If a laptop suddenly costs way more because of a tariff, you might just hold on to your old one longer,
Right.
Or look for a cheaper brand.
Sure.
So if tariffs push up prices on PCs and smartphones, we could see a really substantial drop in sales. The report even suggests the most exposed companies they mention, HP and Dell, could face EPS declines of over 20%.
EPS decline, so a big hit to their profitability per share. Wow, over 20%. That's substantial.
It really is.
But it's not all doom and gloom for hardware, is it? The report mentions some areas might be more resilient.
Exactly. And what's interesting is the variation within hardware. So servers, for instance, are much less dependent on China.
Oh, really?
Yeah, only about 5% of U.S. imports originate there. It's mostly Mexico and Taiwan dominating that market.
Okay.
And similarly, networking equipment, things like routers and switches, It has some exposure, maybe around 12% from China, but you see significant sourcing from places like Vietnam and Thailand. So those segments
Yeah.
expected to be much more insulated.
Are there specific hardware companies the report calls out, either good or bad?
Yes, they do. Mineral Solutions gets a positive mention. They're highlighted for having like minimal China supply chain exposure.
Okay.
Plus, a lot of their revenue comes from government spending on public safety, which is usually pretty stable.
Right, less cyclical.
Exactly. On the flip side, Apple's valuation is seen as maybe less attractive. The report argues the risks from their huge China-based supply chain aren't fully priced in yet.
Even with the moves to India.
Even with those, they point out that around 80% of imported smartphones in 2024 were still from China. So yeah, the India production is increasing, but China is still massive for them.
It really puts the scale of this in perspective when you look at the overall import numbers. The U.S. imported, what, $3 trillion in goods in 2023?
A huge number.
And big chunks were in categories like electrical machinery and electronics, 26% from China, and machinery, mechanical appliances, parts, 19% from China.
And, as the report rightly points out, China's actual influence is probably even bigger than those numbers suggest.
Oh, so
Because they supply so many components to other countries that then export finished goods to the U.S.
right, the embedded components.
Exactly. China isn't just the final assembly spot for many things. It's deep in the supply chain, providing essential bits and pieces. This interconnectedness just amplifies the potential impact of any tariffs targeting China.
And going back to that elasticity point.
Yeah, that's a crucial differentiator.
Yeah.
The report really emphasizes that because PCs and smartphones are often more discretionary purchases compared to essential infrastructure like servers or networking gear.
Right, you need the network, maybe you can wait on a new phone.
Precisely. So they're much more vulnerable to price hikes caused by tariffs.
Yeah.
People might just cut back.
Okay, let's shift gears then. Let's talk semiconductors. The chips. The fundamental building blocks for, well, everything tech these days. What's the tariff outlook and the potential impact here?
Right. That nice. So currently, they actually benefit from an exemption. No direct tariffs on chips themselves right now, but the report strongly suggests that's likely to change, probably quite soon. However, the biggest impact isn't expected to be from direct tariffs on the chips.
Okay, so where does the impact come from?
It's expected to be largely indirect, affecting the end markets where these semiconductors get used. Think cars, industrial equipment, phones, PCs, all the things we've been talking about.
That makes logical sense. I mean, semiconductors are usually a component, not the thing you buy directly off the shelf. And the report talks about how complex the global semiconductor supply chain is, right?
Oh, incredibly complex. Manufacturing capacity is heavily concentrated in Asia. South Korea, Japan, Taiwan, China are the big players.
Yeah.
But the chain is even wider than that. It involves multiple other countries for specialized equipment, essential raw materials. It's a real global web.
Disruptions anywhere can ripple through.
Absolutely. Disruptions in one place can have these cascading effects everywhere else.
So the main worry for semiconductor companies isn't tariffs on their chips, necessarily, but more a drop in demand for the products that use their chips.
Precisely. That's the key indirect risk. Tariffs on cars, for example, could make them more expensive, fewer people buy them.
And fewer chips needed for those cars.
Exactly. Lower demand for the semis inside. The report also flags geographical revenue exposure as a big risk.
Meaning where they sell their chips.
Yeah. Companies that get a large chunk of their revenue from sales in China could be particularly vulnerable if there's an economic slowdown there or, more trade friction.
And we can't forget the semiconductor industry is notoriously cyclical anyway, boom and bust cycles. How do tariffs play into that?
That's a really important point the report raises. Tariffs could actually make those cycles worse.
Amplify them.
Potentially, yeah, by increasing the odds of an economic downturn or even a recession. If demand for end products falls because of tariffs, it just makes the typical industry slump deeper or last longer.
It's also kind of striking just how interconnected this world is. The report uses Apple's supply chain as an example.
Yeah, it's fascinating. The sheer number of different semiconductor companies that are crucial parts of Apple's ecosystem, it just highlights how broad the impact could be if tariffs significantly disrupt smartphone production or demand.
And then there's Taiwan.
Ah, yes, Taiwan. The report calls it a significant tail risk.
Tail risk meaning low probability, but huge impact if it happens.
Exactly. And Taiwan is absolutely pivotal for advanced chips.
Especially for AI.
Especially for AI.
Yeah.
The vast majority of the most advanced cutting-edge AI chips, they're made in Taiwan right now. Any disruption to access their geopolitical reasons, anything else would have massive, just massive implications for the whole tech world.
Okay, so hardware and semis are definitely facing some considerable headwinds here. What about software that often feels a bit more insulated from physical trade issues?
You're right. Generally speaking, the direct risk to software from tariffs is lower. Software itself isn't usually hit with import duties like physical goods.
But they're not totally off the hook.
Not entirely immune, no. The report points to indirect risks, like their exposure to those same tariff-affected end markets we keep mentioning.
Right, if retailers or manufacturers struggle.
They might cut back on their software spending. Exactly. And also, just a broader economic slowdown, maybe triggered by tariffs, that would naturally hit overall software sales too.
And there was something specific in the report about, was it de minimis something, the duty-free limit?
Yes. The removal of the duty-free de minimis treatment for imports, specifically from China.
How does that hit software companies? It sounds like it's about physical goods.
It is about physical goods,
Yeah.
but it gets interesting for e-commerce platforms.
Mhm.
Basically, this rule change means low-value items coming from China and Hong Kong, which used to sneak under the tariff radar, will now likely face duties.
Okay. And the connection to software is?
Shopify. The report specifically calls them out.
What?
Because a big chunk of the total value of goods sold through their platform, the gross merchandise value, or GMV, comes from merchants selling exactly those kinds of lower value goods imported from China and Hong Kong.
So if those goods get more expensive due to tariffs.
Fewer sales, potentially.
Yeah.
The report estimates Shopify could see a noticeable drop in their GMV, maybe around 7%, and a significant hit to their earnings per share because of this specific change.
Wow. Okay. What about the other big software players like Meta or Google? Ads are their big thing.
Yeah, the report suggests they'll probably face some headwinds too, mainly from reduced ad spending by Chinese companies. They mention names like Shein and Temu specifically.
So less money spent advertising those goods in the U.S.
That seems to be the thinking. They do anticipate some potential revenue decline for Meta and Google from this, but the analysts believe these risks are kind of already factored into their current stock prices, so maybe less of a surprise there.
It is somewhat reassuring, though, that the report does identify some areas within tech as being lower risk overall. You mentioned software generally and cybersecurity.
Yes, exactly. Software and cybersecurity were presented as being more resilient in this kind of environment. Cybersecurity especially is expected to keep benefiting from long-term spending trends.
Because everyone needs more security, regardless of tariffs.
Pretty much.
Yeah.
The need for digital security just keeps growing, and it's less tied to physical goods tariffs. Within software overall, the report specifically favors companies like Adobe and Microsoft.
Why them?
Strong market positions, diversified businesses, just lower overall risk profiles in this specific tariff-focused context.
Okay, let's turn to the elephant in the room, or maybe the silicon brain in the room. AI investment. Seems like tariffs and geopolitics could make things pretty complicated there.
That's absolutely spot on. It's a complex picture for AI. The long-term view for AI investment is still seen as positive, though.
Why is that?
Well, the report emphasizes its crucial role in things like making U.S. manufacturing more cost-effective and also for national security. So it's likely to stay a key long-term focus for investment, both government and private.
But AI doesn't exist in a vacuum, right? It needs hardware.
Exactly. And that's the critical link back to semiconductors. AI needs massive processing power,
Which means?
which means it's subject to all those same supply chain risks we talked about for semis, especially access to those really advanced chips, many of which come from
Taiwan.
Taiwan. Precisely. The report also flags potential risks to VC and private equity funding for AI startups. If the broader economy really takes a hit, money might get tighter.
And thinking about the big tech players, the Magnificent Seven, does the report pick a favorite in this environment?
It does, actually. Among that group, Microsoft gets the nod,
And the reasoning.
mostly because its business is so diversified, and it has relatively less exposure to the biggest tariff risks, like heavy reliance on retail, huge China hardware supply chains, or depending mostly on ad revenue.
Makes sense.
The report also adds a little note that the whole AI theme, the valuations around it, have maybe become a bit cheaper recently. So despite the short-term uncertainty, there might be long-term opportunities there.
Okay, so pulling all this analysis together, based on these potential tariff impacts, what kind of overall investment strategy or risk management approach does the report suggest?
Well, given all the risks we've discussed, the tariffs, the economic uncertainty, the report basically advises managing risk proactively. Don't just wait and see what companies say in their next earnings call, because it'll probably be pretty vague anyway.
Be proactive. So what does that look like?
The recommended strategy leans towards favoring those lower risk areas we identified.
The software and cybersecurity.
Exactly. Companies like Palo Alto Networks in cyber, Adobe, Microsoft in software, they're highlighted as preferred picks. And even within semiconductors, they suggest looking at companies like Synopsys and Cadence,
Why them?
because their business is more focused on the software and intellectual property side of chip design, which is generally seen as more stable and less directly exposed than the manufacturers.
And the report actually gets down to individual company risk levels.
Yes, for those who want the deep details, the full report has exhibits looking at specific companies' hardware, semis, and assessing their sensitivity to tariffs, how vulnerable they might be in a recession, and potential risks to their fair value estimate. Really granular stuff.
Okay, let's try and bring this deep dive toward a close. We've definitely covered a lot of ground, lots of complex info. What are the absolute core takeaways you think our listeners should hold on to?
Yeah, summarizing it. I think the main thing is that tariffs, potential or actual, could really reshape the tech industry significantly. The report makes it pretty clear. Hardware, especially things like PCs and smartphones, and the semiconductor industry face the biggest potential disruptions.
Mostly due to China's supply chains and that demand elasticity issue.
Exactly. On the other hand, software and cybersecurity look more insulated, more resilient to these direct risks. And AI. Huge long-term promise, but it's definitely tied to those semiconductor supply chain risks, particularly Taiwan.
And for you, our listener, why is really getting a handle on these potential shifts so important right now?
Well, understanding these potential changes is just crucial if you want to navigate what's happening in tech, whether it helps with your job, your investments, or even just being an informed observer of these big global trends.
Yeah.
The fact is, global supply chains, geopolitics, trade policy, they're all tangled up now, and they have a direct, real impact on the technology we use every single day, and obviously on the companies making it.
So here's a final thought for you to maybe chew on after this. As these lines between tech economics and international relations keep getting blurrier, how might we as individual consumers, maybe as businesses, how might we proactively adapt to what could be more fragmented, more regionalized technology ecosystems in the coming years?
That's a really good question to ponder.
Definitely something worth thinking about as these global dynamics keep playing out. Thanks for joining us for this deep dive.